Investment Management, 6th Semester BBA of Mangalore University. Module 1, Investment. Session 2, Risks of Investment. The risk is the expected loss or failure of an event. The negative return of an investment is treated to be a loss, and the positive return is a profit. The investments are subject to all kinds of risks and are not risk-free. Every investment is subject to the following risks. They are business and financial risk, purchasing power risk, interest rate risk, market risk, inflation risk, social and regulatory risk. Now let us study one by one the different types of risks. Business and financial risk. Business risk is an operating risk which is associated with the normal day-to-day operation of the firm. The business risk is concerned with the difference between revenue and earnings before payment of interest and tax, interest to the creditors and tax to the government. Financial risk tends to make earnings of the company unstable and financially weak. The variance, the change or the variance in the return on investment is the financial risk. Purchasing power risk. Purchasing power risk is an inflation risk and it arises out of change in the prices of goods and services due to changes in the value of money. Inflation risk is the variability in the total purchasing power of an asset. It arises from the rising of general price level. So if the prices of the goods and services increases and the income of a person doesn't increase, then it is difficult for him to purchase the products, and this is what purchasing power risk. Next is interest rate risk. The fluctuation or the change in the rate of interest on bonds and securities is the interest rate risk. When the interest rate rises, the price of the bond falls, and when the interest falls, the price of the bond rises. Similarly, when the price of securities in the corporate sector falls, the interest rate will increase. Market risk. Market risk is referred to as stock variability due to changes in investors' attitudes and expectations. Market risk arises out of changes in demand and supply pressure in the market following the changing flow of information or expectations. The market is intolerable. The market risk is, that is for the equity shares, is much greater than in case of bonds. Inflation risk. Just like the purchasing power risk, inflation risk is the variability in the total purchasing power of an asset. It arises due to the rising general price level. Social or regulatory risk. The regulatory risk relating to climate and legislation may impair the profitability of the firm. The risk of price control, business control, and environmental control reduce the profitability of the industry. The regulatory risk is more in industries related to public utility sectors such as telecom, banking, transportation, etc. The social risk is really political and it is unpredictable. But under a system of representative government based on increasing government intervention in business affairs, no industry can expect to remain exempt from it. So these are the risks prevailing in the social circumstances in the society. Thank you.